Hello again. As you have figured out by now, I am doing another brief overview of another chapter. So today we're talking about Unit 6, Instrument of Real Estate Finance. We are not going to go over the whole unit. I know you're reading through those things, going through your key terms, which there are a lot in this unit, okay? So instruments of real estate finance really have to do with the actual mortgage document that is filed, the one that is signed at closing and that is filed and recorded. But we're going to kind of talk about a few things and how it relates. Okay, so that's what all of these videos have been about, is how what we're learning actually relates to real life in real estate. So the first thing you see when you're entering this chapter is it talks about encumbrances and liens. Okay. So there's two types of liens, voluntary and involuntary. Involuntary means things that we can't control, right? So tax liens, judgments. If you had ever been evicted from an apartment, you probably have a judgment against you. Lasts for 10 years. You might want to look into that. If you have a child support judgment, we see those come up on these things. If we do see a lot of taxes, if people don't pay their taxes, that comes up when you try to buy a house. Okay. Then you have voluntary liens. These are liens where you have basically used your house as collateral. Okay. So one of them is swimming pools. Some of the above ground swimming pools, they'll put a lien on your property. They may call it a UCC lien. That's Uniform Commercial Code because they are a business. You may have a UCC lien. They also a water softening system, but right now the most popular one we're seeing is solar panels. Yeah. So from the real estate's perspective, solar panels do not add value to your house. And we'll probably talk about that some other place. I don't know. But just know that solar panels will create a lien on your property. So you need to know about that. So those are the two types of liens that you see. And there is an instrument in the real estate transaction called a title commitment, and you'll learn more about that in a different course. But in that title commitment on Schedule C, that's where we get notification of what liens are on that property ahead of time. And it is very important that you pay attention to that. So loans are always secured by a real estate interest, and a lot of times that loan is secured by the real estate interest of the property. So you're not having to get excess collateral, you're just using the real estate interest of that specific property. Now, we're not going to go through the whole chapter talking about notes and deed of trust, because a lot of that stuff is very self-explanatory, okay? And we're just going to talk about how these things relate kind of to real life real estate. Now, we all know what a mortgage is, right? A mortgage is the payment that you make for the house. And there are four parts to your actual mortgage payment. It's called PITI. Okay, it's your principal, interest, PI, taxes, and insurance, TI. So there's four parts to that, to your actual mortgage payment. And your lender will capture all four of those parts. Principal and interest, of course, belongs to the actual lender, but they also capture taxes and insurance to protect their interest. And we'll talk about that. One thing we do need to make sure that we understand is everything in real estate transfers under a legal description, not the 911 address. So, not the address to the house. We don't transfer property with an address. We transfer property under the legal description, whether it be a lot and block, whether it be an abstract, whether it be meets and bounds. However, that legal description is scripted is how we actually transfer property. So, the same way that we do that for writing a contract is the same way that it will be transferred on the instrument used for the promissory note, which is the mortgage instrument that would be recorded. So, property taxes we talked about are the T in the pity. Okay, so you had the principal interest, PI, and then the T for taxes. That's your property taxes. And this is a part of your monthly payment. Now, why does the mortgage company make you have that as your monthly payment as part of it? Well, it's because property taxes are what's considered an ad valorem tax. That means it's a first interest tax, which means it takes first step, first interest. It means if you don't pay it, it goes into the first position of foreclosure. Okay. So if the mortgage company is going to make sure that that tax is paid because they don't want to lose their first position. That mortgage company, if you just decide not to pay your stuff or whatever, of course we're not going to do that, but if you decide not to pay your mortgage payment, your mortgage company is going to pay those property taxes. Because if they don't, then the county will take over the property because they'll be in first position rather than the mortgage company. So those are always going to make sure it's paid. So then you have insurance. And so insurance is the I, and it's the second I in the pity. And in your promissory note, it states that you have to have hazard insurance at all times. And usually it says what kind you have to have, and that you have to name your mortgage company as additional insured. So what that means is if something catastrophic happens to your house, then not only will you get to have it paid, but your insurance company as well. So, oh, sorry, guys. So, for example, hailstorm comes, you got to get your roof replaced, like everybody. Okay. Your mortgage company is going to make your check out your insurance company is going to make your check out to you and your mortgage company to where you can't pocket that money because that money is meant to pay for the investment that the mortgage company has. So, because the mortgage company has an investment in your house. So, it has to have both of you on there. So that's important to know. So don't be surprised about that. And a lot of times I have owners, even owners of property management, uh, that don't understand why their property management company has to be on as additional insured. And it's because we're making sure that their house stays in good condition for their tenants. Foreclosure power in mortgage companies have the power of foreclosure. And it says that in the promissory note document that they have the power to foreclosure, and it actually goes into how they do that, what the process is. And these are all documents that someone would wet sign at closing because we're still wet signing a lot of our documents at closing, and this is one of those that they would do. So I'm going to skip over to kind of some of the other things, the special provisions. So special provisions in mortgage lending documents are kind of crazy. Okay. But it's some of it we need to know because people skim over it and then they're kind of caught off guard and we get asked questions a lot about it. So one of them is a late payment penalty in Texas. Okay, and I'm going to say in Texas because in other states it's different. Imagine that. So in Texas, all loans are due on the first. Doesn't matter when you close, your loan is due on the first. and it's not late till the 15th. Okay, so really the 16th. So it's not late till the 15th. And then you're going to be charged a percent of the principal only, and it's usually 4%. We have seen that go up a little bit here lately, but it's usually 4% of the principal only. And I will tell you this, you must make your first payment. If you do not make your first payment, they will automatically start a foreclosure proceeding. It's amazing to me how many times I have sat in a closing and someone has asked, when do I have to make that payment? Oh, you mean I have to make the first one? Like, we went over this, but yes, you have to make the first payment. Yeah, so it's funny. You have to make all of them when you buy a house. There are not prepayment penalties on certain types of loans. Okay. So that's something to pay close attention to. Prepayment penalties are a thing. If you have a VA or an FHA loan, you will not have a prepayment penalty. On an FHA with a bond, you may have a penalty on the bond, but you won't have a penalty on the longevity of the loan. On other types of loans, like conventional with certain financing things, you may have a prepayment penalty. So you will always want to check with the lender to make sure what type of prepayment penalty you may have. Okay, this one's always a fun one. It's called due on sale clause, which sounds kind of weird, right? And it's like due on sale. Like that sounds like I have to pay it all as soon as or when I sell it. Well, yeah, we do pay off the house when we sell it. No brainer. But what this means is when where this really comes in is it says the condition stipulates that a borrower shall not sell, transfer, encumber, means uh, add on to, assign, convey, or in any other manner dispose of the collateral property or any part thereof, or turn over the management or operation of any business on the collateral property to any other person, firm, corporation without the express written prior consent of the lender. Okay, what that means. Two things. One, let's say you have, okay, I'm going to use my next door neighbor. My next door neighbor has a wonky piece of land. It is weird shaped. And when you look at it, it looks like it really kind of belongs to the next door neighbor on the other side of her. So they had talked about, well, you know what? I'm just going to sell them this one chunk. It was like a triangle because it was literally on their side. It was like on their property. It was just weird. It was weird the way the developer did it. And so they were like, I'm just going to sell it to them because they can use it more than me and I could use the money, right? So they asked me about it because I was their realtor. And I said, you better talk to your lender because that can cause a problem because your lender has vested interest. Your mortgage company has vested interest in the entirety of your property. So she was like, okay. So she called her lender or her mortgage company, and mortgage company said, not no, but no. And they said, if you do that, then we will call your note. Calling your note means it is due and payable 100%, the balance. So then I've had another client who they had heard because they were turning their property into property management, and they had heard that if something happened on their property that they could get sued. And so they wanted to put it in an LLC so they would be more protected. And so they couldn't get sued. And so they came and asked me about it. And I said, no, you can't do that. You can't. I said, if you do that, this is what could happen. If your mortgage company finds out, which they're going to find out, but if they find out, they can call your note and make it due and payable. And they said, well, my friend did it and that hasn't happened to them. And I'm like, okay, I'm just telling you what the rule is. The rule is if you transfer your personal home or a home that was in your personal name into an LLC or any other kind of corporation, and it has a mortgage still on it in your personal name, then they can call your note and make it due on sale clause because it's technically you sold it to your LLC. You transferred it. So lo and behold, 6 months later, they call me back and they said, oh my gosh, you won't believe what happened. We just got a letter. I was like, you just got a letter? They're like, yeah, they called my note. I was like, oh. They said, what are we going to do? I said, well, you're going to have to go to the bank and you're going to have to get a commercial loan because LLCs cannot get personal loans. They can only get commercial loans because they're businesses. You're going to have to get a commercial loan and take it out on it as an investment property and put 25% down on the house. So anyway, so it's a little bit of a hot mess, but kind of something that happens. So just for fair warning. Another thing that is very popular right now is assumptions because what is happening to the interest rate? We talked about that in Unit 1. Interest rates fluctuate. People who bought their houses 4 years ago and got the 2.75 interest rate, now interest rate in February of 24 is 7.25%. So they want to assume the loan of someone who has a 2.75, right? Wouldn't you want to do that? Yep. There's some tricks to it, okay? But assumptions are becoming very popular so people can get those lower interest rates. Now, assumptions have a couple of tricks to it, like we talked about. So you have to be able to have the equity in cash or be able to get a secondary loan. And they take a long time. So they could take anywhere from 60 days to close to 6 months or longer. There are some lenders that are taking up to 9 months to close these things. So assumptions are very popular right now. The other thing that's becoming popular, and it touches on it in the book in the same places it talks about assumptions, is something called subject twos. In our real estate world, subject twos kind of have a bad rap. And in lending, there's a place for everything. Okay. So any kind of scenario, there's a place for it. Subject twos have been used by investors lately for creative financing. And that's the phone call we get is they'll call and they'll say, is your client open to creative financing? And as soon as they use that term, I know they're talking about subject to. And subject to financing is very, very risky for a seller because they have everything to lose. And the investor, the buyer, literally can walk away at any time and it all falls back. All of the liability falls back onto the seller. So I predict in a few years, all of these subject twos, it is going to be a huge housing crisis. It's going to be a big problem. So that's something. So really pay attention to that subject too, because I see that is going to become an issue going forward in real estate when you're becoming a real estate agent. So that's kind of what I'm going to talk about Unit 6 with the instruments of real estate. There's a lot more in there, a lot more clauses. a lot more things that you could need to know about, extensions and modifications. We've seen a lot of loan modifications being done coming out of COVID, but this video has been way too long, and I know you've got a lot of reading to do and the quiz and everything like that. So I hope you're tuning into office hours. If you're needing assistance, tune into the office hours on Monday evenings, and because I am here to help you understand any of the concepts. And also, always do not hesitate to send me a message, send me questions. I will help you any way I can. All right, guys, you have a good week, and we will see you for Unit 7.